This is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us. Hello, this is Hall Martin with Investor Connect. Today we're here with Fraser Hall of the Vancouver Founder Fund. Fraser, thank you for joining us.
Thank you. Great to be here.
So how did you get into early stage investing?
So my path is unique for our geography, but not that unique for, say, Silicon Valley. So I'm a multi-time founder. My last business I built, it was called Recon Instruments, a heads-up display company that built sunglasses and ski goggles with heads-up display and computers inside. And we exited that business to Intel in 2015. And through that process, we learned that there was a lack of capital in this area, but also a lack of supportive capital that understood startup, understood tech. And it's a problem we wanted to solve. So we treated it just as we had my co-founder in Recon and I thought, this is a problem that needs solving. Let's start a fund and solve this problem. And that's what we've done.
And so what does your fund focus on as far as you have a geographic preference there, it seems?
Yeah. So we focus on the Pacific Northwest. So it's a geographic fund. Different in some ways. Most funds are vertical oriented. We feel that at the early stage, you can be more generalist. So we provide a lot of services to our companies, as many VCs do, but they're far more general. So we often aren't deeply involved in industries we invest in. There's areas we don't touch. We don't do anything in health sciences, pharmaceuticals, or clean tech, areas where the economics are just simply so different. But we will look at pretty much any other area of startup and tech. One of our checkboxes in our investment process is that we have to be able to add value from day one. So some businesses, we simply just don't know enough about that industry and we'll have to bow out. But we do find lots of deal flow in areas where we can add value immediately.
Well, that's great. So you're a micro VC fund, and that's a very interesting model that's coming up. We see a lot used around the country at this point. And maybe you can tell us a little bit more about the micro VC model and how do you run a fund like that?
Sure. So there is definitely a temptation to build larger and larger funds. And we've been very explicit about matching the size of our fund to the size of what we feel the opportunity is and being very safe with the size we choose. We really want to provide great returns to our LPs. So it means that post kind of Series A, chances are we're not cutting checks anymore. So we can usually follow on once or twice. And then we have to pass the baton to a larger fund to write the larger checks down the road. It works well in our local market. We generally write checks about around the $1.5 million mark. So we'll go as low as $750,000, go as high as maybe $2-3 million on a first check, and then we reserve for follow-on. And we feel it's working. And any VC, I believe, is following a hypothesis, and it's never entirely proven because we're shifting that hypothesis with time. But we do feel that so far, the traction is in our direction, that a hypothesis is proving true, that we can provide both value and funding to businesses through several stages. But then when you get to Series B, we're going to have to find you an appropriate, generally a fund, usually it's an American-based fund that is very specialized in their particular vertical.
So in a micro VC fund of, say, $25 million, how many deals can you really take into your portfolio given the first check and the follow-on check that would need to go with it? What's the average number you can manage?
Yeah, we're expecting to invest between 10 and 12 businesses with our second fund, which is a $30 million fund. So that's pretty small. That's a pretty concentrated portfolio. I think some would disagree that portfolio theorists would think that you need far more companies in a portfolio in order to hit that massive win that kind of makes the fund. Our model is slightly different in that we look for slightly de-risked businesses. We don't need $10 billion exits. Several $100 million exits are massive wins for our size fund. So for us, 10 to 12 companies. Our model also is very high touch. So we simply wouldn't have the bandwidth to provide the services we'd like to much more than that.
Well, I also noticed that a lot of micro VC funds have a very specific investment thesis, and I see that you're in the Pacific Northwest and de-risk businesses, and the funnel starts to get tighter as you add those together. So you're not looking at deals across the entire North America region. You've got much more limited amount of deal flow. How much does that play into your investment thesis?
Well, it does. Deal flow isn't necessarily the issue. We see a ton of deals. In the last couple of years, probably see about 600 deals a year, and we do maybe 4 or 5. So there's lots of flow, but it is generalist. So once you kind of tap into a vein that you start to like, say, educational technology or fintech, sometimes there isn't the next deal around the corner that you can use your learnings to go after. Now, that being said, we're not entirely restricted to the Pacific Northwest. This is the area that we source deals from. We do see the odd deal from outside because we have certain expertise, mostly from our founding background. I founded a business called Article.com, which is a direct-to-consumer e-commerce business. And then both my co-founder and I have founded this Recon Instruments, which is a heads-up display hardware business. So we do see deals specifically in those areas where people really want us involved, but we don't solicit deals outside of this area. So that's kind of a caveat on our thesis.
So as you have founders that are really running the show here, what advantage do you think you have over the VC that they really have never really been operators? They've just been financial or investment or something else. What advantage do you find yourself holding there?
I think the largest advantage, when we set out to build our first fund, we thought, okay, we're gonna be able to provide all kinds of strategic guidance along the way. And there's some of that, but as with probably any VC, you're essentially a full-time recruiter and part-time therapist. And so ends up being the things we do the most of. So tons of recruitment and tons of being that shoulder to cry on, that trusted party to bounce ideas off of. And I think at the earlier stage, there's even more of that. These are often CEOs that are 1-2 years into their career as a leader, and they're looking for a lot of help, a lot of sounding board. As they progress into the later stages of finance, so there's, say, Series A or B and so on, they've developed a certain skill set and processes and so on, and they might not need that shoulder to cry on quite as often. So I think it serves us well at the early stage.
Well, the micro VC model is a relatively recent thing. It's been around 3-5 years, maybe longer, but I've seen it come up really strong in the last 2 years. And the VC model in general is undergoing a lot of change. Where do you think it's going, and where do you think it's going to evolve to?
Yeah, that's a really good question. So micro VC, we're seeing it in this part of the world as well. Every week it seems like there's a new micro VC. I think it's very trendy to be a VC right now. It's become to some degree sexy. Not sure all those will succeed. Many will fail or will not be able to raise money or have different views of what it is to be a VC. Now, I do see VC changing quite a bit. In this part of the world, the VC experience that I had as a founder is old-fashioned. It's company founder, you kneel before me, and if I find you worthy, I dub thee with my sword, and now you're a slave to me, and you report to me regularly, and I tell you exactly what I want you to do. This is the experience I had with VC, and I think it should be entirely the other way around. I consider myself a service-based VC, whereas every interaction I have with a founder is, what can I do for you? What is it that you need help with? Not what can you do for me? And I think we need more and more of that. There's groups definitely, especially in the Valley and so on the East Coast, that are already taking that position where the founder's providing the value. We have to be supporters rather than directors. And I really see a shift in that direction. Already we see great deal flow that people are fleeing the traditional VC model to come to people like us.
Well, it seems in addition to the micro VC, I also see the VC plus service model coming up where we do the back end, we take care of your CFO work, we help you find customers, we prepare you for the exit. And while all that's somewhat implied in the traditional VC world, they really aren't equipped to do all of that. And so I see a lot of VC plus service groups coming up with very specific focused offerings, so it differentiates their funding. You want my $500K, not their $500K, because mine comes with services. How far do you think that's going to go?
Yeah, I don't think it can go that much further. I've spoken with a lot of, especially late stage VC, and they've got massive impact teams. And I guess the logic for them is all that matters is they win the right deal. And if it costs them a headcount of 100 people in extra impact, then so be it. We have to make sure we get the deals we want. I think probably it's already swung a little too far, where being a founder myself, I wasn't looking for, when I was out looking for money, I was looking for money and maybe a little bit of advice and a little bit of speaking with someone that's got scars in their back in my particular vertical. But when I was out, I was never looking for, I don't really need a CFO and a full-time recruiter and a legal team. And all. I've kind of already figured out most of those things. How about just some money and some advice? And I think we probably have to move back towards that. But I'm happy to hear that most VCs aren't at least charging for it. Back 10 years ago, sometimes groups would say, here's some money, and we have all these other services, and we'll charge you for them, which sounded kind of underhanded, where you took their money and then they slowly siphon it back from you for their staff.
The dreaded phrase chargeback. When you hear that, you start looking for the door. So services are still there. It just doesn't sound like it's just any and everything that needs to be done a la carte. What services do you think are really the VC is well positioned to provide? I know maybe it's advice, but advice in what direction?
Yeah, I think it does depend by stage. At the later stage, you're generally looking for very specific industry knowledge. You're looking for potential intros to acquirers or banks for IPOs, things like that. These are areas most founders have never been through before, and they're looking for someone that's been through the stage they're about to go through. At the earlier stage, often there's very simple things. Where should I set up office? Who should I hire? How should I build out a management team? What exactly is product market fit? Should I be focusing on growth or bottom line today? Kind of more business fundamental problems. These are the areas that we spend a lot of time on. And we feel we add a lot of value. And plus, we just simply love doing it. We're founders at heart. So we're kind of financiers that's the title on the card, but we really just love operations. So that's kind of more where we spend our time on the service side of things.
Well, shifting gears a little bit, I'd like to go back to that geography of the Pacific Northwest. You probably have a great position to understand that geography. And what do you consider the strengths of the Pacific Northwest startup ecosystems or the companies coming out of it?
Yeah. So first of all, the Pacific Northwest, I would say, is kind of an adolescent phase. There's fully developed ecosystems on both the East and West Coast, further south of us. And then there's smaller kind of satellite ecosystems in smaller towns and so on. So we're kind of in this adolescent stage where we're still kind of trying to find our feet. There's not as many head offices here, so you can't source as much talent locally. So you're generally bringing in people. But first of all, it's a fantastic part of the world to live in. We're a very short flight from the center of the tech world being Silicon Valley, same time zone, so on. We now have satellite offices for many of the large Silicon Valley headquarters who are up here. So the talent is being developed here. In Canada, there's all kinds of government programs which really assist startups. And it's just an entrepreneurial culture that we find is pumping out a great number of really high quality companies. But it's still that adolescent stage. Most haven't made it really large. Many exit a little too early. It's just that kind of growing up phase where we don't have every segment of the market yet, but it's been incredible watching over the last 10, 15 years how this ecosystem has developed from essentially services and resource-based tech that serves those areas to now companies competing on a world stage.
Well, it sounds like it's growing very quickly. What do you see as the opportunities for the ecosystem? What sector, stage, or type of companies you think it's going to do best with?
Yeah, so this part of the world is strangely, it's actually known for a lot of branded product. So the Lululemons and Hershel's and Aritzia's and things like that, headquartered here in Vancouver. So it's an interesting niche. So Article, a company I co-founded, is growing very rapidly in the furniture space, and it fits well. There's lots of staff in the design, style, direct consumer area to grow. We're also seeing pockets in ed tech and fintech in the area. So I'm not even exactly sure how these pockets necessarily erupt, because I don't know why ed tech is particularly suitable to the Pacific Northwest, but that seems to be, I guess, one company does well and others spin off from it. So those are a couple areas we're seeing a lot, but I guess there isn't really one strong vertical that's really dominating the area.
Well, it seems like there's a lot of great companies that are coming out of the Pacific Northwest. And of course, there's new segments like AI, fintech, blockchain, and the like. And sometimes the universities or sometimes the previous generation of companies have left a lot of well-trained people in the area. Here in Austin, we had MCC, IBM, Cimatech, and a lot of those initiatives come through in the 80s and early 90s, and they basically left us with a whole bunch of very smart semiconductor people. And that became the foundation for a lot of the follow-on startups that came out in the enterprise and other places as well, but didn't know if you had any history there that you saw carrying from one generation to the next.
Yeah, there's a little bit. There's some semiconductor work up here as well. But really, specifically in Vancouver, which is our largest market, this is a resource-based economy, or was. It's transitioning away. Technology is larger than resource now. But it's real estate and resource. And so there's traditionally, say 5 years ago, most tech companies were serving those two industries. Only more recently have companies really sought to service the world. And so some research is coming out of our local universities. But I think the larger one is already spin-off talent out of companies, but these aren't massive companies. These are spin-offs out of $100 million companies, not many billion-dollar companies. So again, I think it points to the early, that kind of adolescent stage of the area.
It seems like it's still early days, just like Austin, where I'm from. It's also an adolescent group that's growing fast and receiving a lot of attention from the big companies where they want to open secondary offices, a lot of tech talent and so forth that they pick up. Not everybody is destined to be a CEO, and a lot of them end up working for other tech companies in other ways. And so it's a good fit to carry that entrepreneurial spirit forward, at least in the tech world as well. In the last few minutes that we have here, what else should we cover that we haven't?
I guess just getting back to the business fundamentals approach, I think VC traditionally has operated on this idea of the power law, where really one big win is going to make your portfolio. And I can see the logic there. It's just, as certainly with the portfolio sizes we had 10 companies in our first, we'll probably have 12 in our second fund. We simply can't rely on that type of a distribution. And it's just not really my style, frankly. So we take the approach of, let's get some, I guess many would call third base hits, a couple $100 million exits, but de-risked to a large degree, not figuring out unit economics later, figuring out early, but still trying to swing for the fence as best as you can with solid unit economics. So that's the kind of businesses I think will stand the test of time. And I'm building yet another portfolio of those type of businesses. So that's just a little snapshot of kind of the way I think about startup.
Well, great. Thanks so much for this information. How best for the audience to get in touch with you?
So I'm best reached at Fraser, that's Fraser, at vff.vc. Best way to find us.
We will put that in the show notes as well. Thanks so much for joining us, and hope to have you back for a follow-on to carry the discussion forward.
Great. Well, thanks for your time, Hall.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.